It's time for Retire Right with Reverse Rob, diving deeper into housing wealth and utilizing a portion of your home's equity as a coordinated strategy in retirement planning. Now here's your host, Senior Retirement Mortgage Specialist at Fairway Independent Mortgage Corporation, Rob Kanyur.
Hey, well, welcome to the Retire Right with Reverse Rob show. My name's Rob Kanyur. I'll be your host today. I'm a retirement mortgage specialist here at Fairway Home Mortgage and Senior Vice President of Fairway's Reverse Division. And I run my own branch at Fairway Home Mortgage, and we exclusively do reverse mortgages. So that's all I do is live, eat, breathe reverse mortgages, or what we refer to as retirement mortgages, or some may refer to as HECMs. What the heck is a HECM? A home equity conversion mortgage. So that's been my story for the last 11 years. I've been in lending for over 27 years now. And the reason for this podcast that you're listening to or watching right now is to just disseminate an accurate information out there about reverse mortgages, because even after, well, the first reverse mortgage was done in 1961, FHA took the program over in 1988, we still have a lot of myths and stigmas and misunderstandings out there. So we're using this podcast and inviting very wise and knowledgeable guests onto the show to just have a chat, about home equity and retirement. And today we're fortunate enough to have my very good friend Dan Hultquist on with us from Reverse Plus. I've known Dan, known of him for over 10 years now. We became acquainted about 6 years ago when we were both working at the same company at that time, and have just evolved from there, just a mutual respect for one another. He's been on my radio show before, and I was able to pull him away from a busy schedule and con him into I think I threw some Penn State football tickets in there. That's off the record to have him be on. But Dan, hey, welcome to the Retire Right with Reverse Rob show. It's so great to have you back. I'm glad to have you.
My pleasure, Rob. I always enjoy talking shop with you. And so I've always admired your professionalism. So looking forward to the call today.
Thanks, Dan. A little bit about Dan. He is an established reverse mortgage industry educator, writer, speaker, and advocate. Dan has the honor of helping others like myself develop a better understanding of reverse mortgages. While he generally teaches the nuts and bolts of the federally insured HECM product, Dan also has the pleasure of coaching and educating others on strategic uses of reverse mortgages in retirement. He began writing the book Understanding Reverse in 2012 and published the first edition in 2014. This book quickly became both an industry resource and a marketing piece as it simplifies the reverse mortgage. The book is updated annually, and new editions are released in January. Dan Hultquist's knowledge of finance and the mortgage industry has allowed him to promote the advantages and proper use of reverse mortgages. Dan enjoys speaking about technical aspects of the industry and has been featured at NRMLA, National Reverse Mortgage Lenders Association, and MBA, Mortgage Bankers Association events over the last 10 years. So Dan, welcome. Again, so grateful to have you on today. What is new? What is cutting edge stuff going on right now in reverse mortgage world? Talk to me.
Yeah, well, we're in a different environment with products. And so we're trying to model all the various products with our software. So Reverse Plus was a company built specifically to explain the reverse mortgage in new and different ways. And, life was so easy, Rob, when we were just selling the HECM. But now we have these other products and we want to be able to model and compare. And, it's the loan closing is the loan beginning, right? That's the first day of the reverse mortgage. And we want to show what happens over the next 5 or 10 or 15, 20 years. And so we've built software that does that. It's specifically built for the loan originator, but you can use that software to model for your clients so that they get a better picture of what's going on. I'm also doing a little bit on the education side. Of course, that's my passion. And so you mentioned the first reverse mortgage in 1961. I was just looking at the obituary of Nelson Haynes, the loan originator on that loan today. And sadly, he passed away in 2022. And I thought, man, I got to interview some of these people, some of the patriarchs, the people who got the reverse mortgage started. And so I've been working on that too. So software and education, I've been kind of doing it all right now.
That's great. It was great seeing you in May for our first mastermind in Tennessee, and the collaboration there was amazing. I was the first one to sign up for next year's mastermind. It was that good. So looking forward to that. And education's key. And I was, this week I've been kind of reflecting on, some of the challenges or reasons why we haven't gained more traction in the mortgage industry with getting more folks. And I think a lot of it, correct me if I'm wrong, just it starts with, the company, the mortgage company, and the loan officer. Is that mortgage company truly dedicated to reverse, or are they just jumping on the bandwagon? Has the loan officer been vetted and certified? Because this loan is a lot more complex, and having the non-recourse feature, which we'll talk about, is much different than a forward mortgage, a traditional mortgage. The HomeSafe second, the reverse mortgage second is much different than a HELOC, and I want to talk to you about that as well. But really focusing, and personally as a senior vice president of the reverse mortgage division at Fairway, is really focusing on reaching out a hand to other loan officers and colleagues, because not only at Fairway, but outside at other mortgage companies and banks and credit unions that don't offer this product for various reasons. And I feel that if we can continue to educate them, you hit something earlier when we were discussing prior to going on the air about, a newbie class for originators and really talk about, like what I do with new originators getting into the reverse space, is talk about the history. Like we talked about the first reverse mortgage. No one knows that the first reverse mortgage, not many anyway, you and I do, that it was done in Portland, Maine in 1961. No one really knows that it evolved, after FHA and HUD took the program over in 1988. And prior to that, correct me if I'm wrong, I mean, in many cases that they did tag the house away. And so 40 years later, people still think that. And then when we ask them what color a yield sign is, as people are listening to this driving right now, I say or ask what color a yield sign is, and what are they saying right now as they're driving, listening to this?
Most people would say it's yellow.
Right, they're saying it's yellow, and it's funny because the yield sign hasn't been yellow since like the 1970s, so it's crazy. So reverse mortgages, they don't take the house away any longer. After history, talking about the objectives to doing this, why I just emailed a new financial advisor here in the Phoenix area today. A follow-up. We spent an hour and a half on a Zoom call yesterday. He gets it. He gets it. So those are the type of financial advisors we want to work with. Not only open-minded, but they're comprehensive. So they're CFPs, certified financial planners. Those guys are the real deal. With all due respect to any financial advisors out there, comprehensive fiduciary, meaning that they're looking at the whole picture. They're not a product-based, it may be a fee-based advisor where they're going to offer their client all the options. And if it makes sense, they're going to recommend, hey, this is something you need to look into. But secondly, to that point, you need to make sure that I'm referring you to, I don't like to use the word expert, but seasoned pro that just does reverse. Like my old mentor, who said, how do you know if you are true? If you get pulled over by a cop and you're accused of being a reverse mortgage planner or retirement mortgage specialist, whatever term you want to use, are you going to be guilty? Are they going to charge you guilty or not? And I can, on the way over here with all your material that I have out, and your books and everything, and your pamphlets and everything, I would be guilty as charged. So that's imperative. And then talking about the objections, which I want to kind of talk to you a little bit about as well today. So go ahead and take it away and give me your thoughts on that.
Well, I agree with you on the education side. now more than ever, you've got to be an expert to sell this product, because it's not just the HECM. You have the other options that you're talking about. But there's one more element that I would throw in there, and that's personal buy-in. I know you and I have discussed that at length in the past as well. Now, I don't originate reverse mortgages. So when a client comes to me and they say, hey, I'm not sure if this is the right option for me, I ask them about their experience with the mortgage loan originator. And when I talk to them pre-application, I say, you need to go back to your loan originator and ask them one critical question. What's your plan for your own reverse mortgage? And if they waffle on that, they're not the right person for the job, right? So personal buy-in is very important to me. Do you understand the product well enough that you would use it for yourself and your family members? I would. And Rob, you and I agree on this. Our friends and family have it.
Yeah, I'm about 4 years off from being eligible for the HECM, but I will say that I have colleagues here that they've wanted me to do their personal HECM here at Fairway as a loan officer, as an originator. They want I've closed it for them personally. I have many of my clients, over 400 of them now, over the course of the last 11 years of doing these, specializing in these. I'd say out of over 400 clients, I would say at least 10% of them are referral partners, meaning they're financial advisors that have their own reverse mortgage. They're realtors, they're CPAs, they're fellow loan officers that are age 62 or older. And I'm going to take this even one step further as far as personal buy-in. Yeah, I'm all in. But personal buy-in also starts at the top with the leadership of the mortgage company. And be quite honest with you, I feel personally that every employee of a mortgage company from the top down needs to go through the reverse mortgage certification training, because I would say 80% of them, I'm just throwing that number out there, still after 11 years of us doing these, or being a player, a major player, top 5 consistently in the nation with origination of reverse mortgages, they still don't completely understand it. And I will even take that further and say most of them, 90% of the case studies I've looked at, and I've looked at thousands of case studies as of you, 90% of those meet one of the 6 objectives to doing a reverse mortgage. And there are people here, executives, branch managers, regional managers, vice presidents, senior vice presidents, operations managers, non-originators, operations side, non-sales side, that could benefit from them. And if we literally could close, a couple thousand reverse mortgages every year, if we would really be able to scale and get them to see the light that, hey, this is not just some loan of last resort that you take out after you've had the last garage sale, sold everything on eBay, and raided the kids' grandkids' piggy bank one last time, and right before you file for Chapter 7 bankruptcy, you call Rob or Dan to get a reverse mortgage. That's not how this loan is used any longer. We're in the modern era of reverse mortgages, to the extent where this is a loan of first resort and not a loan of last resort. And even further, I'll add to that I'd say over half of my clients are mass affluent, higher net worth clients, because they understand the power and of cash flow in retirement, portfolio longevity, leaving a larger legacy to the heirs. And there's this thing called income taxes. And for more affluent, higher net worth clients, taxes are can be a deal breaker in retirement. And we have an answer. We have a solution to that. We have a solution to protecting the surviving spouse, liability protection against lawsuits, and title fraud with how the note and deed are recorded. So yeah, I'm if you can't tell, yeah, I'm all in. I buy in. I think that a lot of us as we get older don't look forward to getting older, but one thing we do look forward to is reaching age 62 to do the HECM, or maybe even take a detour and go down to the non-HECM proprietary product, which goes down to 55 in most states, or many states at least. It's state specific, unlike the HECM, which is federally. But yeah, I'm all in.
No, there's a reason why they call me HECM Man, right?
Yes.
I'm a big fan of the HECM. Did you do know that I'm wearing my HECM outfit today?
Well,
Right?
I figured that you might just be. I need to get. I don't know if you can have a shadow Hecka man, but I'd like to be your sidekick. I don't know what we would call me, but I love it. Yes, you are Hecka man. That's cool.
Yeah, I'm 5 years away, so I'm right there behind you. I know that I'm going to get one at age 62, and my plans have changed a little bit over the last few years, but I qualify for a proprietary reverse mortgage right now, right, at age 57. But I'm gonna wait for the HECM that has an age requirement of 62 and older.
I hear you. Same here. I got about 4 more years, so I'll be taking the deep dive and improving my retirement picture, and ultimately having peace of mind, the ability to sleep at night. And that's going to affect, that's a legacy decision that, I mean, how much equity do we have now trapped in seniors' homes who are age 62 and older? It's got to be around 15 trillion.
I think we're at 14.92 maybe trillion dollars. That's insane.
And obviously, every situation's different, much like anything else. So it is imperative that while you're listening to this, or after you listen to this, is to contact me to see if this is a good fit for you or not. And the best way to do that is just to call the reverse hotline at 602 reverse. That's 602-738-3773, or email me at robk, R-O-B-K, at home.com, HOME.com. So robk at home.com. But we want to review your situation, and the key to this with working with a seasoned pro like Dan or myself is that I'm going to tell you whether it makes sense or not. And I also want to talk to you, Dan, about, after we talked about the various products and options, is to talk a little bit about, are they in the right house? And this would be catered towards or directed towards realtors. Realtors, by the way, much like certified financial planners, are fiduciaries. So in many cases, I have probably, at least I would say probably a couple of dozen realtors that have their own HECM, their own home equity conversion mortgage. And they refer clients to me, and they'll say, Rob, either they want to age in place, or it's $1 million property, they want to downsize to 750. Or if we can sell the $1 million property and put them into a 750 home and only, not have a mortgage payment and still have money left over in their pocket, then they're going to go that route. That agent, ideally, from a commission standpoint, if they sell the big house and they downsize to, or right size to, the next house, that's 2 commissions for that agent. But if that borrower talks to me, and I'm actually doing one right now, where the discussion will be, are we going to age in place, or are we going to move? And if that borrower, and this has happened, elects to remain in the existing home, that realtor is giving up 2 commissions, a list side and a buy side. And they're perfectly fine with that. They just want their client to be happy and take care of that's what it's all about. That's what a true fiduciary does. That is a true realtor. That is the only type of realtor that I will work with. And the same with financial advisors. Dan, if a financial advisor comes to me and wants me to do a reverse mortgage for a client so that their client can purchase a whole life policy or an annuity, I was trained or taught or mentored to run the other way. I will not partake in that. And it's not me with a halo over my head. It's called a thing called integrity and character. And
Well, from a product suitability standpoint, I think the conversation starts with, do I want a traditional mortgage or a reverse mortgage? Like, that's the initial basic discussion. And I've been at traditional mortgage conferences where there's a lot of people, and I've spoken, and they gravitate to the 30-year fixed. Everyone believes that that's the safest product, right? But it's not. The moment you're 62 and older, why would you want to have a required payment when you can have an optional payment? And so to me, I consider the traditional 30-year fixed, or 15, whatever you're going to do, VA, USDA loan, FHA, the traditional mortgage lending route is dangerous once you're 62 and older because crap happens, right? When you turn 62, you don't know what's going to happen in retirement. Market forces, inflation, medical expenses. I mean, the list goes on and on of the things that could come up and bite you. And now you can't make a required payment. If you had a reverse mortgage, the payment would be optional. So if you have the resources, make a payment.
Yeah, some of our clients make a payment.
And I'm planning on doing it. I'll do it strategically in years that I'm going to itemize so that I get the deduction. But yeah, I would much rather have an optional payment. So that's really the first decision, traditional or reverse. And to me, it's black and white. You're 62 and older, it would be irresponsible to get a cash out refinance or even a HELOC. A HELOC's really no more secure because you're still going to make a payment and it can be taken away from you at any time.
Yeah, Dr. Barry Sachs talks about that. Dr. Barry Sachs, top retirement tax attorney in the nation, as you know, Harvard law grad, got his physics degree from MIT, I think. So I kind of think he's kind of a smart guy, but he basically says, and I'll convey this to clients and referral partners, Dan, that HELOCs are in retirement, especially, are risky and dangerous. You mentioned you have a payment. Well, yeah, it's only interest only. It's only an interest only payment. I can afford it. Yeah, you can afford it right now because you have both you and your spouse collect Social Security. You are in the first 10 years of that HELOC. And then after 10 years, one spouse passes away, the loan recasts to a fully amortized payment over a 20-year term, or they freeze it or cut it. And then they're up the creek, literally, so to speak. So HELOCs don't cost anything. I was just thinking about this yesterday with regard to HELOCs, and you can virtually get one. And it was advertised today on a blog, a gentleman by the name of Rob Chrisman, and I want to actually tell you a little story about Rob Chrisman and his blog today. It's a little joke. It's pretty funny. I don't know. At least guys will think it's funny, but he was talking about this company that can close a HELOC in 5 days. Ooh, that's great. We can close a HECM in 15 days here at Fairway. Whatever. But who cares? And it doesn't cost anything. You get what you pay for. So I can go to a paralegal or a physician assistant to get medical care. But if I'm in a lawsuit or in litigation, I'm gonna go to an experienced, high-powered attorney, and they're gonna cost more. Or if I need to go have my heart checked out, I'm going to go to a cardiologist, not to a foot doctor or a general practitioner.
Yeah, as far as HELOCs, they're cheap, right? And when you use the word cheap, there's a couple connotations there, right? You get what you pay for. You're probably not getting high quality. And so, yeah, a HELOC is cheap. It's inexpensive, but you get what you pay for. I would also add that, once you've gone down the path of the reverse space, understanding, hey, I'm 62 and older, and this is going to be the safest loan that I can get, the next consideration from the client is, well, do I want a lower rate or do I want more proceeds? And that's a critical decision, and why you need to work with an expert now more than ever. Because back in the day when the HECM was the only game in town, well, if you gave them a slightly lower rate, they got a slightly more proceeds, right? So you could get a little bit more when rates were low. But now we're in a totally different world now, where we can increase their rate with a proprietary product and give them, in some cases, massive amounts of more money. But is that in the right interest, the best interest of the client? We have to do more investigation. We want to make sure that we educate the client. Yes, I could give you more money, but you're sacrificing equity over time. I could give you a lower rate and you have more liquidity over time with the HECM product, with the line of credit. And so those are the conversations I know you have, experts have. The novices, they're just going to ask the client, what do you want? Do you want the lowest rate or do you want the more proceeds? And most clients today are actually dollar sensitive and not rate sensitive.
Yeah, they are. I'm seeing that more on my side. With, when I'm looking at all three options, if they have an existing mortgage per se, then we do the reverse mortgage second in many cases. They want to keep that lower rate in the 2% range on the first forward mortgage. But I'll have one call where they're like, the rate is between 9 and 11% on the proprietary non-HECM product, non-FHA product, which goes up to a loan amount of $4 million, by the way. And they say, that's fine. I just want to get as much cash as I can. And then I'll have a conversation with another client, like the one in Rhode Island, who happens to be a brother of one of my top financial advisors. And we looked at both. It's on a condo there. So there's going to be some more hoops to jump through with FHA as far as getting that condo FHA approved. So we were leaning towards the proprietary. But then when we looked at the interest rate and what their rate of return was on their existing investments, we flipped back over to the HECM. So that is the type of conversation you want to have and include the financial advisor, the CPA, the estate planning attorney on. So yeah, like I said earlier, every situation's different, but we have to, our job as an originator, as an expert in the industry, is to review all those and give them the ups and downs or pros and cons of each one and explain, well, because then at the end of the conversation, it's like, well, what would you do? It's like, well, in my current situation, this is what I would do, but then my situation is different than yours, as far as I'm very more leaning towards paying less taxes, having better cash flow, and potentially leaving a larger legacy to our 5 children. That's important to me.
It might be good for your viewers to know, well, when do you go prop? Prop for short, proprietary, when do you? Well, from my perspective, obviously, if the borrower is under 62, that's going to be their only option because props generally start at age 55. So you're talking age, you're talking about massive home value or massive loans. Maybe the client can't accomplish their goals with the amount of money you can get on a HECM, but you can get more money on a proprietary. I get that. You mentioned condos. So approved condos, with the HECM product, it's got to be an FHA approved condo, which is like 6.5% of all the condos in America. So there's some flexibility when you're looking at condos. What about solar leases?
Oh, I'm meeting with a mom, a client today, and her daughter that were referred by their friends from church, and they were working with another reverse mortgage company, and then they ran into a buzzsaw with the solar because the solar company's gone bankrupt. I know that's hard to believe. Yep. And they can't get a hold of anybody, and they're saying that they can't, the UCC filing, and so we're going to get that deal. We've had that situation come up many, many times because, like I tell my team, we learn something new on every file, and we're always striving for perfection and settling for excellence when we're working with clients. And we'll get over the hump. The other cool thing about Fairway Home Mortgage, I'll toot our horn again, is the fact that we have our own FHA condo approval desk. So we had a client about 6 months ago, a Vietnam veteran, who was in a condo in the North Phoenix, Scottsdale area, and it wasn't approved. The agent and the forward loan officer came to me and said, hey, we've got a client that is running out of money. He is a diabetic. He's got kidney failure. He's on dialysis. He needs oxygen tanks, and he's on the verge of losing his home or having to move out of his condo into an apartment and rent. And we got that condo approved, I want to say in about 2.5 weeks by our Fairway condo approval desk. And during the stint of the transaction, he was hospitalized with pneumonia and he almost passed away. It was hellacious, but he came into the office, signed his loan docs. We had a pizza party. It was life changing. Not only did we give back to a veteran who, was a Vietnam veteran, who, made sacrifices for our country and our freedom. We were able to change his life completely, turn it around with no mortgage payment, and give him some additional cash so he had some breathing room. And, I would talk to him on the phone. He'd be going to Kroger or whatever, Fry's Food and Drug to get groceries. Barely can walk, barely can drive, barely can afford groceries. And we changed his life with this loan and that was a HECM on a unapproved condo. So little story. Facts tell, stories sell, right?
Well, there's probably much longer list. I mean, I can think of a few more why you would go prop. I mean, the initial disbursement limits on a HECM product, you can't get all your money up front. You have to wait, a year to get the rest of your money. The other reason I would add is, well, the HomeSafe second is a proprietary product. And it's for those clients who are so enamored by their 2.75% interest rate that they're not willing to get rid of that, right? Yeah, we can go down that path too and talk about the HomeSafe second if you want.
Yeah, we're doing one right now for a client, and it's better than a HELOC or a cash out because they get to keep that set. We go in second position behind that 2.75% interest rate on the 30-year fix that they have, and the payment's manageable at $1,000 a month. They're going to continue to make payments on the first, on the whatever it is, 30-year fixed mortgage that they've had for 5 or 10 years. They want to, they can, and they're going to have better equity at the end because they feel that having more equity at the end is more important than having cash. So we have to have that conversation as well. But that HomeSafe second is really picking up. We're seeing probably 1 out of every 4 or 5 of our transactions right now is HS second.
I like the product. I'm fascinated by a second lien product, but for your viewers that aren't familiar with this, it's for anybody who has an existing first lien, a forward mortgage they're paying on, and they're quite comfortable paying it. They don't have to wipe that out. In fact, they're proud of the fact that they got that low rate. They're going to continue to make that payment. They're going to get a second mortgage that doesn't have a monthly principal and interest mortgage payment, a reverse. And so I'm fascinated by it, partly because with a reverse mortgage, most clients don't make payments, so the loan balance goes up over time. That increases the risk to the lender. The longer you live, it gets more risky to the lender or insurer in the case of the HECM product. But with the HomeSafe second, what we call crossover risk, where you owe more than the value of the home, that actually goes down. And so it's the opposite of what you would normally expect because they're still paying that forward mortgage down. It's amortizing. And so the client actually has more equity over time. So I'm fascinated by it. But like I said, clients are so fascinated by their low interest rate and they're proud of it. They're like, I timed the market. I refinanced at 2.5%, 2.75%, 3%. And they brag about it to their friends. And the one way I like to explain this is my wife bought Apple stock before iPod came out, right? And Apple stock wasn't worth that much. She bought it because she's a graphic designer and she likes the software. And she said, I like this company. I want to invest in it. Great. Knock yourself out. I didn't think it was a good investment at the time. But, it's so hard for her to sell that. People who bought stocks at such a low price, they don't want to sell it because it's a source of pride to them. And so unfortunately, people make poor decisions sometimes when pride gets involved. Sometimes it'd be good to sell that Apple stock. Probably not, but sometimes it might be good to get rid of that first mortgage. And I know that sounds insane to a lot of your viewers. Wait, I have a 2.75% and you're telling me to go to something in the 6s? Because of liquidity, right? You're giving up something. Yes, you're giving up that low interest rate, but you're gaining cash flow, liquidity, lower taxes, and higher net worth. Does it make sense? Well, only an expert mortgage originator would be able to tell you that.
Let's talk about I want to just touch on the objectives with our listeners. And if you're watching, viewing this on YouTube, but the objectives to why would I want to do a home equity conversion mortgage? And as I mentioned earlier, we're in the modern era of reverse mortgages. So this is a loan of first resort rather than a loan of last resort right now. And I like to use the analogy of Dr. Wade Pfau, who's also going to be a guest on the Retire Right with Reverse Rob show, or returning guest. But he uses the analogy of climbing Mount Everest. You've heard this analogy before, where he'll ask his viewers or his listeners, where do most deaths occur on Mount Everest? And I'll ask that question in my classes too. I teach continuing education to real estate agents and to certified financial planners, and most of them will say on the way up or at the top. So on the way up in retirement, or on the way up, we're in our earning years, you and I right now, in our 30s, 40s, 50s, and even 60s now. And so we're climbing the mountain. We have a Sherpa, we have a group, and we have shelter. We have a paycheck coming in, commission or W-2 wage earner. And then we get to the top of Mount Everest and we plant the flag, aha, I've arrived, beating our chest that our house is paid off. We have $1 million in the bank. We have no debt. We have 2 cars in the garage, a white picket fence, and a Labradoodle. And, life is grand. And then that's not where most deaths occur, and that's not where we start to run into risks with regard to retirement. It's on the way down the mountain, when we're coming back down, when we're descending, and that's where most deaths occur. In fact, if you watch a documentary on Mount Everest, there are still frozen bodies, dead bodies up there from decades ago, that it's easier just to leave them there. They're frozen, right? And then try to go down and try to retrieve them and get them off the mountain. So there is a lot of people right now in this country, and they don't even know it yet. The frog is boiling, right? 1 degree at a time, and they don't even know it, Dan. And it's like, wake up, coming down the mountain. That's retirement, and that's where it's really risky with regard to, no pun intended, but sequence of returns risk, where we have clients and retirees pulling money out at record rates from their retirement in down markets, and they're never going to replace that. They're getting killed on taxes because they don't understand the tax stacking strategies that you mentioned earlier with regard to itemizing on your tax returns. They're living longer. Divorce rates have tripled since the 1990s. The only one that benefits from a divorce are the divorce attorneys. In divorce, in many cases, is not the answer, period. And that is devastating to your financial picture, devastating. I mean, we're literally in your 50s or 60s, and you have to start all over again. It's like if life in retirement and taxation and inflation were bad enough, let's just cut your assets and your income in half and see how it's like being a one-legged man in an ass-kicking contest. It doesn't work. So, that's the analogy I like to use. And what is a good case study for a proprietary? There are people listening on here, and the best the way to look at it would be, to contact me. And you can even visit my website, www.reverserob.com, or call 602-REVERSE, or email me at robk@home.com. And I will tell you that we had a client just recently. This one was in their 80s, and they had a $3.7 million property, and they owed about, I want to say, $900,000 to $1 million on a regular forward mortgage, and the mortgage payments on that, Dan, were about $5,000 a month. So they're paying $60,000 a year in mortgage payments, and their income was about $40,000. So I think there's a little bit of a math difference there, or a little. And so they they owed the IRS $170,000. They got into a pissing match with their HOA because they had their cars parked outside their garage in a very strict HOA golf community in North Scottsdale, Carefree, Arizona. And the fine from the HOA was $500. The amount they owed the HOA was $25,000. Why was it $25,000? Because of the HOA attorney fees was $24,500. They begged, borrowed, and stealed from all their family members and neighbors. So then they come to me, loan of last resort. They're in foreclosure, and on a $3.7 million property with $2.5 million worth of equity in there that's going to be lost. And they waited and waited, because why did they wait? Ostrich syndrome and pride and arrogance. Ostrich syndrome meaning their pride, or they had their head buried in their sand. There's so many people out there right now, retirement or non-retirement, that are just kind of ignoring what's going on. They put their fingers in their ears and they start going la 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 la, and they're just like, oh, the government will take care of me, or I'll things will work out, rates will come down. Interest rates are not coming down anytime soon. We're in, what is today, August 7th of 2026. I think a 30-year fixed rate is nearing 7% again. Like when I got in the industry in 1999, rates were like 7.5. Prime was at like 9.5. People betting on rates going down is like betting on Apple stock going down. It's just not going to happen in the near future. So they wait too long. That client, we were having, I won't get into deep in the weeds on the challenges we ran into, but we're literally doing triage on this client. Loan of last resort. Why do they wait too long? If you are listening to this right now and you are in retirement and you have a free and clear home, or you even have a mortgage, contrary to what Susie Orman says or Dave Ramsey, we can do a reverse mortgage on your house whether it's free and clear or if you have an existing mortgage on there. So I want to make sure all of our viewers and listeners know that. But that loan, Dan, came down to the wire. It was the beginning of February, and we were having trouble getting the payoff from the HOA. I know it's a big surprise. And the IRS gave us two different payoffs, one directly to the borrower and one to us. And so we're going one hurdle after another, one road speed block after another, to the point where we didn't get loan docs to title until Monday for them to sign. The mortgage company, they had a first and second to boot, to add insult to injury, and the first mortgage lien holder, we having trouble getting the payoff from them, and it delayed the transaction to the point where they had already extended the foreclosure, the trustee sale by twice. So we were asking for a third time for them to extend the trustee sale, and they said, no, we're not going to do that. And the trustee sale was on a Thursday. So I'm signing them on a refi on a Monday. The trustee sale is happening on a Thursday. Is that a problem? Yes, because they sign their loan docs. The 3-day right of rescission doesn't have the reverse mortgage funding until that Friday, which is a day late and $1 short, and they're going to lose the house. First time in my career, I would say over 7,000 mortgage transaction over the last 27 years that I've done. First time in my career, Dan, that I got the investor to agree to waive the 3-day rescission period.
Wow.
And we funded on a Wednesday, a day before they were going to go lose that house. That is how this loan is used. Obviously, we don't want it to come to that point. We want them to dig their well before they're thirsty and get the oil changed before the car is smoking on the side of the road. So I'll let you chime in on your thoughts on that. And then I want to talk here in the last 10 minutes of our interview about your amazing software that we're using to enhance the reverse mortgage in retirement.
Sure. So the case study that you gave is what we would consider a typical needs-based borrower. And when I got into the industry, that was 95% of the business, right?
Yep. Loan of last resort, needs-based.
Yeah. You need money and you need it yesterday. In your case, you literally needed it yesterday.
Exactly.
You know, that's your typical house rich, cash poor, and you might have viewers that are in that boat, and we can help. Rob can help, and that's something that I always took a lot of pleasure in. That is, I considered it a calling, a ministry. Like, I can help people out of their worst crisis financially with a product nobody understands. And so for me, I took a lot of pride in that, but I would say that's pretty small piece of the pie now. It's lifestyle enhancement is big. And in my book, I talk about the 3 different types. Needs-based lifestyle enhancement could be, hey, I need a new car, or I want to update the kitchen, or put a stair lift in, or maybe I want to take my family on a African safari. We had a client that just wanted to buy a bottle of wine so that they could go to social events without breaking the budget. I was like, that's very sad that they stopped going to social events because of a bottle of wine.
Yeah. I'll have that discussion with clients too, where I'll say, You can go out to dinner, have date night once a week and not feel guilty about it.
Lightens the load a little bit. That would be lifestyle enhancement. But where I know you and others are starting to excel is in the financial planning side for the non-needs-based, the affluent, and people with a paid-off free and clear home. I'm not going to need a reverse mortgage. I don't know. Maybe I will. I don't think I will. I don't think you're going to need a reverse mortgage, but you're going to want it because of what it does for you.
Want-based loans, I mean,
liquidity, taxes.
Yeah. 2 years ago, we did a reverse mortgage for a client in Beverly Hills, California, with a net worth of $45 million that did a home equity conversion mortgage on a free and clear home. And all of his golf buddies at the country club and his pickleball buddies and his polo buddies at the polo grounds were poking and prodding him and making fun of him. And he's like, why wouldn't I tap an illiquid asset? I saved, by doing the home equity conversion mortgage, I saved over $280,000 out of my portfolio by covering capital gains on another property. Another estate planning attorney, or an attorney in Chino Valley, Arizona, near Prescott, $25 million net worth. One of my very own financial advisors that came to an event about 6 years ago, net worth of, he gave me a case study sheet, 63 and 64 years old, $1 million free and clear home, $7.5 million in assets in retirement funds. I call him the next day and I go, hey, this is a great case study. Let's give the client a call and let's present it together. Key, hint, hint. Don't try to, if you're a realtor or a CPA or a financial advisor listening, don't try to explain this to the client without getting with a retirement mortgage specialist or expert in the field to present it together. And when I said that, Dave's like, you're talking to him. It was for this financial advisor. And that story, I've got 10 or 12 or 15 or 30 other stories just like that. So to your point, this loan is evolving. And I mentioned we're in the modern era of reverse mortgage, where it's evolving to a want-based loan for higher net worth mass affluence clients rather than need-based. Will we help the needs-based loan? I mean, yeah, a few months ago, we helped the client with a CPA with a $6 million net worth up in a golf community in Scottsdale, Greyhawk golf community. And he just did it. He was referred by another CPA or his financial advisor, but at the same time, we were closing a deal for a client, a needs-based down in Maricopa, Arizona, on a double-wide trailer. And he was doing it because he needed the money for his chemo because he was dying of cancer, and to put a new front door on his trailer because it was falling off. So, I mean, we cover the broad spectrum now. So no one is immune or disqualified for a reverse mortgage. I mean, it's 90% of the time. And if you're in that 10% category, God bless you. Have a great day. And keep on keeping on.
Shall we take a look at some case studies?
Yeah, let's take a look at some case studies on your software here.
This is a typical example that we might see. Is Tess is in Arizona, age 70, wants to maybe look at some financial planning options, has $1 million home, owes $200,000 on it. And so you can see on the right here in the blue, this is the home value of $1 million. I can give her $375,000 today, right? But after costs and liens, we have what's left available in green is right over here of $146,000, because I'm going to use that $375 and to pay off the existing mortgage and closing costs, and I'm probably going to set up a line of credit for the remainder. Couple things over here when I go into the refinance screen is I look at that $200,000 and I want to know, well, Tess, what are you paying right now? Well, I'm paying $2,800 at 4.5% interest, and the software automatically calculates 7 years remaining for this client. So they're already over here with a traditional mortgage making a payment for the next 7 years of $2,800. Does she want to make that payment? Well, not in perpetuity or not in the next 7 years. So what we do is we take a look at projections over here and we say, listen, if you do make the same payment with a reverse mortgage, your loan balance will drop. It won't drop to zero, like your traditional mortgage because it's a little higher interest rate than you're paying right now. It's not 4.5%. And we're financing the closing costs as well. But if you wanted to take $2,800 and make an optional payment, you're welcome to do that. And the client comes back and says, yeah, but I'm thinking about retiring in 4 years. Well, this is what a reverse mortgage would look like for you. Now, keep in mind, this is the loan balance in red. What you have in the green is liquidity. We call that the massive green wave of liquidity. That's the line of credit that grows over time. And then the client says, yeah, but I'm thinking about getting a reverse mortgage because I don't want to make a payment. Well, you're welcome to do that, and your loan balance will rise. But does that mean you're losing equity? No, we actually show that you're gaining equity with the reverse mortgage, and we'll get to that here in a moment. But one of the things I really like to do with our software right at this point is say, you don't have to make a payment and you've made that choice. Now, what happens if property values don't rise at 4%? Maybe it's 3%, 2%, 1%, or heaven forbid, my home doesn't appreciate in value over the long run. That's okay. Two very magical things happen. Number one, your line of credit is unaffected by that. You still have access to line of credit that exceeds your home's value, which is amazing. The second thing that happens is by age 90, your loan balance is capped, or the loan balance due, if you were to sell the home at this point, your loan balance due is capped at the home's value. And that's the essence of the non-recourse clause. So this software models very clearly the two things that matter to the client. Will I have access to money? Yes. Can I ever be upside down on the mortgage? No. So that's your basic example. I often talk about the borrower's equity position over time. Maybe I want to watch that line of credit grow and convert it into more cash flow in the future. But this one's been really cool, is to be able to say, instead of putting that $2,800 into your reverse mortgage, if you took that payment for the next 7 years and put it in a brokerage account or put it with your financial advisor, the dark green is the money that you put in over the next 7 years, $2,800 every month for 7 years. The light green is the return you're getting on that investment. So by the time I'm 90, I have $749,000.
That's gonna come in handy.
Fascinating. Now that would be a typical non-needs-based borrower because they have the ability to make a payment. Sure. It's not critical to them, but are they better off with a reverse mortgage? Absolutely. Now let's move to someone who is a very needy borrower, and we call him eliminate payment because he kept saying, I got to get rid of this payment. I got to get rid of this payment. So, okay, Mr. Eliminate Payment, we're going to try to help you, but you're in Tennessee at age 70, you have $1 million home and you owe $450. Okay, so this would be his situation. There is the home value in blue. I can give you $375, but when you factor in costs and liens, we're short to close by $100,000. Now, Rob, you're a professional in this space, so the first thing you're going to look at is, well, can I solve his problem with a proprietary? Well, until a couple of weeks ago, there were no proprietaries in Tennessee, right? The next thing you say is, hey, Mr. Eliminate Payment, well, what do you have in your 401k and IRA? Can you come up with $100,000? Unfortunately, the answer was no. The next question is, do you have any family members that have $107,000?
Oh, everybody has a family member with an extra $107,000 laying around.
Sure. And there's nothing we can do with the HECM product to help this client. Most loan originators nationwide would say, I'm sorry, Mr. Eliminate Payment, but I can't eliminate your payment. The solution is actually very easy, is to have a very frank conversation with Mr. Payment and say, I'm looking at this saying you're in the wrong house. You're in Tennessee in $1 million house, presumably outside Nashville somewhere. The answer is, would you be willing to downsize to a $738,000 home? We will take your $1 million property minus real estate commissions, minus the liens you owe against it. And I'm not telling you to go out and buy a home for $490,000 in cash. You could, but my guess is that's not in the goal for you. But you could buy a $738,000 home, and that would use up all that $490,000. Now, the client did an amazing thing. The client said, well, if I'm going to downsize, I probably want to be closer to my kids and grandkids. And so I could actually find something in, say, the $525,000 range and be very happy. Well, then not only did we take your budget deficit, which, by the way, was over $2,000 a month, and made it a budget surplus of $1,000 a month, because we wiped out that mortgage payment, but we're giving you $138,000 in cash, presumably tax-free after selling the home. Now, there might be some small capital gains associated with it, but I'm getting you $138,000 in cash and solving your problem. And Mr. Eliminate Payment doesn't need to worry about eliminating that payment. We'll do it for you, and we'll do it in less than 30 days.
That's a win-win-win right there.
So that's a typical that's a needs-based borrower right there where, hey, they desperately need a reverse mortgage. It's not going to be a refi. It's going to be a purchase. And so that's why I labeled this a purchase instead right here.
How can they reach you if they want to get, we have your booklets here, Homeowner's Guide, Reverse Mortgages Made Simple. We got the Home Buying Guide, which is what pertains to what we just talked about right now. We have a financial planning guide. I've been giving out the, Understanding Reverse. You wrote the first, I think, copy was published in 2015. I'm one of those nerds that has like a copy of every year. You help me with that edition of every year. But Understanding Reverse is great for someone who's just listening to this and learning, the beginning phase. And Navigating Reverse is a book is your second book that came out that I give to referral partners, particularly financial advisors and CPAs and estate planning attorneys for that matter, as a reference guide. We are giving out closing gifts now to our clients, and we have a client that's signing loan docs on her HECM on Monday. Her name's Diane, and it's been about an 18-month journey with her on whether she was going to do it or not, switching financial advisors, and she's going to be getting we're going to be giving as part of their closing gift a copy of Navigating Reverse, in addition to What Do I Do When My Loan Becomes Payable and Due, and that book and that handout from Nirmala is going to go in her binder, her closing binder, as a reference.
So if you're a consumer, Amazon, if you're going to buy one copy, Amazon's probably the way to go. So that, just look up Understanding Reverse or Navigating Reverse are the two books that are on Amazon. If you're a loan originator out there watching the broadcast, you probably want to go to reverseplus.com. That's where we help you with some software solutions. We've got the books there as well. It's actually going to route over to understandingreverse.com, which is my site. But reverseplus.com is probably where, if you're an industry insider, that's where you're going to go.
Well, I appreciate you being on our new quote-unquote podcast, Retire Right with Reverse Rob. Again, my name is Rob Kanyur. I am a retirement mortgage specialist, SVP and branch manager with Fairway Home Mortgages. Reverse is all I do. I can be reached at 602-REVERSE, or you can go to www.reverserob.com or email me at robk, R-O-B-K, @home.com. Dan, you're a gentleman and a scholar. I appreciate you, man. Always great talking with you, sharing with you, and look forward to doing it again real soon, my friend.
Sure. Have a great weekend, Rob.
All right. Thanks, Dan. You too. Bye.
Rob is a senior retirement mortgage specialist at Fairway Independent Mortgage Corporation. Feel free to contact Rob with any questions. Subscribe, like, or share so you won't miss an episode. Download and listen to the audio version on Apple Podcasts, Spotify, or wherever you get your podcasts. Thanks again for listening to Retire Right with Reverse Rob.